Welcome back to part 3 of this session, where we will look at a couple of solutions we have available at Fairtree. We will look at a live case study, as well as how can Fairtree help you manage your investment journey. Let's dive in. So taking it one step further, you will see up on the screen we have a couple of the investment objectives that we have identified in session 2. We have now added our investment products as well. We will have our unit trust for an emergency fund, we will have a unit trust for our MBA degree, and we will have our retirement annuity to start saving for retirement. So we have looked at goals, we have looked at how much you would need to save, by when you would need to save that, and we have also chosen the most suitable investment product for your goal. So this last step will be choosing your investment solution. So we have the container, we have the empty shell now, but what are we going to fill this with? Please note, this is not financial advice. We are simply exposing you to some of the solutions we have at Fairtree, and also the minimum disclosure documents that I'm going to show you is of course correct at the time we have done this presentation or recorded this session, but please make sure that you always look at the latest minimum disclosure documents to make an informed decision. So let's start off with our very first goal, which of course was to start an emergency fund. We're going to use a unit trust for this objective, and let's see what we have available at Fairtree. You will see this will be our flexible income fund that we have at Fairtree, and Kihara has taken you through the minimum disclosure documents and she has taught you how to read them. So let's quickly look at some of these components and see how we can match them to our specific goal. Being an emergency fund, we would need something over the short term with not too much volatility and protecting our capital. So here you will see the investment objective is just that. You will see it is a high yield fixed income portfolio, and the objective is to provide you as an investor with a high level of income. So that is going to be the perfect fit for our emergency fund. But let's also take a look at some of the other elements. Once again, you will see here when it comes to the fund, it will aim to protect capital and to maximize income growth, and the risk indicator also is conservative, which is what we want, once again indicating that this is a fund for the short term, as we would want in the case of our emergency fund, not experiencing a lot of volatility over the short term, so that by the time we need to withdraw money, we won't realize a loss as an investor. Other things we need to consider, and this will actually be very straightforward, because keeping in mind we are dealing with an income fund here, this would be the asset allocation for this specific fund. You will see here bonds, the money market, as well as cash. So it's really not like a large proportion when it comes to equity or property or anything like that, and it is just neatly set out in a pie chart on this side. So yes, this fund ticks all the boxes when it comes to an emergency fund. And let's lastly take a look at the returns. Remember, this is important, but like Kihara has explained, don't jump to the returns first and foremost to base your decision on. Go through the objective, look at the risk profile, make sure that it is a suitable fund or portfolio for your goal before you look at the return. Here you will see the fund has generated phenomenal returns over, well, actually since inception. And here you will see even last year in a very low interest rate environment, the fund has done over 6%. Once again, just mentioning the fact that this is for the sake of when this session was recorded, and please make sure that you use the latest MDD when you choose your specific fund. So this would be an absolute yes when it comes to an emergency fund, and we would say you can consider a flexible income plus fund from Fairtree. Next up, Our investment objective would be doing an MBA degree. We have chosen our unit trust, and now look at what Fairtree can set on the table. Once again, this is not advice, but this is what we have available. And here you will see the risk profile will look different. Now it's not conservative, it is medium to high. The investment horizon also 7+ years. And here you will see the benchmark that we have also spoken about is South African multi-asset high equity. So we more or less have an idea of what we can expect of this fund in terms of the investment horizon, and also when it comes to its asset allocation. If we had to look at the investment objective, you can see here that it wants to outperform the benchmark, of course, which is South African multi-asset high equity. And because it is multi-asset, it is diversified across all major asset classes. And you will also see here that a multi-manager approach is being followed. And I will show you now who the other asset managers are that we also have as part of managing this portfolio. Next up will be the holdings within this specific solution, and here you will see the multi-manager approach. We have included Coronation, we have included 91, and we have included Resco. So we want their skills and expertise within a specific area where they do what they do best, and using this to diversify even further and to complement our portfolio. That is why we include them. You will see this is a look-through principle just of all the other Fairtree funds that also forms part of this solution. So it is properly diversified and very, very well managed. Looking at the asset allocation, you would see there is a big weighting when it comes to equities, making up the majority of the asset split. Remember, this is a high equity solution, and you will of course see there would be bonds as well, and there would be property, there will be cash. You will note that there would be no alternative asset classes within this portfolio because we have not included any hedge funds in here. That will be in the following example. So this would be, as we would refer to, long only in that regard. Looking at the correlation, as Kihara has explained, this is well correlated. So when something is down, the other fund, for instance, would be up, and vice versa, making sure it is properly diversified, and you will, as an investor, receive a good average return across this portfolio. Last but not least, of course, looking at the performance, here you will see the benchmark South African multi-asset high equity in the very dark grey, and here would be the performance of this Fairtree solution. So you can see over the last 7 years, this has been incredible outperformance by this solution, and we are very proud to be the asset managers behind this. So this is a very good option if you want to save for basically any kind of investment goal over, let's say, about 7 years or longer without having exposure to hedge funds. Last but not least, our investment objective of starting to save for retirement. The pine tree, of course, would be the retirement annuity. So when it comes to saving for retirement, we have a different approach because we do blend our long only and our hedge funds. So as I've mentioned previously in the session, we were actually the first in South Africa to do this, and this combination, as you can read here, will really generate excess return and superior portfolio performance because it is a combination not only when it comes to equity, property or fixed income and credit, but we also have directional soft commodities and alternative asset classes here, and then also technology driven algorithms, so all working together to make sure that we provide the best possible return for you as an investor. So let's look at what can be an option, or let's say our best option, saving for retirement. Once again, you will see here in the risk profile space, it's medium to high because it is over the long term, of course. Investment horizon being 7 years or longer. So if you're starting out, that is very important to note, because hopefully you will have about 30 or 40 years to go until retirement, making the most of the fact that time is your friend. And then the benchmark, once again, would be South African multi-asset high equity. If we had to look at the investment objective, you will once again see here that we want to outperform over a rolling 7-year period, once again diversified across all major asset classes, but we are going to see the exposure of the hedge fund components just now when we look at the solution holdings. And you will of course see that this will comply with Regulation 28. You will remember Regulation 28 from the Pension Fund Act that gives prudent guidelines when it comes to investing retirement money. So yes, this absolutely can be used within a retirement annuity. Looking at the holdings, you will see here would be the Fairtree Balanced Prescient Fund, as well as the Fairtree Invest Strategic Factor hedge funds that we manage at Fairtree. And this, ladies and gentlemen, would be the secret weapon. It will be your specialized shoes, and it will boost your performance and give you the competitive advantage. So when we look at asset allocation, here you will see them come through. We would have fixed income and credit directional. Here's our diversifiers. Up there we will have our directional equities and also our directional quants. So it is not only the main 4 asset classes that we include within this solution. Once again, correlation playing an extremely important part, and yes, it is a well diversified solution. Here we would see the return, once again benchmarking it against South African multi-asset high equity being the grey line, and the orange line you can see Fairtree's performance. Once again outperforming the benchmark significantly over a space of 7 years. So just imagine what being invested in this solution can do for you over a space of 20, 30 or 40 years. So the best time to start saving is really now. Now we will look at the live case study that I've referred to at the beginning of this part. This is a retirement annuity construct of one of my family members. It was put together by someone very close to her, but it's not someone affiliated with Fairtree. And this is something that we find in the industry on a very, very frequent basis. Once again, I will refer to this as a standard investment portfolio, and we will see how it compares to what we can offer you at Fairtree. So here you will see my family member is actually invested in a couple of balanced funds at asset managers Red, Blue, Purple and Gold, and there's also a stable fund from asset manager Red. We also have an international feeder fund from asset manager White, and we also have an inflation plus fund at asset manager Black. So here you will see different weightings, of course, the allocation to each one of these funds. So this is what my family members' retirement annuity is made up of. If we had to look at the asset allocation of this standard portfolio, you will see it here right to the left, the exposure to the main 4 asset classes. Once again, right here in the middle is what we at Fairtree offer. You will remember the example that I showed you, or the solution that I showed you when we looked at the 3 investment goals just now. This is actually the allocation then of that solution. Once again, you will see, because we have the 7.5% hedge fund exposure, the directional equity, smart beta, as well as our diversifiers coming through. You will see the green bars would represent the asset allocation of the standard portfolio, and the orange bars, of course, representing the spread of asset classes when it comes to Fairtree. Once again, you will see here there would be directional equities and our diversifiers, of course, which the standard portfolio does not have. And without repeating myself, but just driving the point home, is that this will give you the competitive advantage and having those specialized shoes to run with. So let's look at the return, and this is actually quite remarkable. You'll see this is the return of the standard portfolio. Once again, looking at the 7-year return, almost 7% over the 7 years weighted performance. Of course, we're looking at 7 years and not over 1 or 3 or 5 years, because it is a retirement annuity, so we need to take a long-term view on this. How did this stack up against our solution at Fairtree? Here you will see the 6.9% and Fairtree returning a phenomenal 10.3% over the same 7 years. So this is a significant outperformance, even if it doesn't look like that in terms of percentages. Let's look at the monetary difference it would have made if I invested 100,000 Rand over these 7 years. You will see the standard investment portfolio would have returned almost 160 Rand, and then within our solution you would have received almost 200,000 Rand. So this is a significant outperformance by almost 40,000 Rand over the last 7 years. So you need to ask yourself the question, does my investment portfolio consist of the right asset allocation to generate above average performance? If the answer to this question is no, you know where to find us. But all jokes aside, who do you want to manage your investment journey? Kiara, I'm going to give over to you to shed some light on this. Thank you.
So deciding on asset allocation, as well as making sure that all the elements that we have discussed in the session so far is included inside your portfolio, can be quite a daunting task. So the question is, when it comes to portfolio construction, who do you want managing your journey? Now, remember, we had the concept of active investment versus buy and hold investment. If you wanted to actively manage your investment, it means that you would do the work of the portfolio manager. Where if you wanted to buy and hold an investment, it means that you would hire the portfolio manager to do the work for you. So just having a look briefly at what those two elements actually were. If you were to do the work of a portfolio manager, it would be a very hands-on approach, would require a lot of expertise, whether you should buy or sell the assets inside of your portfolio. It would require a lot more deeper analysis to take place, and you would probably need maybe a team of people to do the analysis both qualitatively and quantitatively, and it can be quite expensive due to the factors that we covered in part 2. Now, where you hire a portfolio manager to do that work for you, they will be the ones actively churning the portfolio or the underlyings, and you will simply be buying and holding that specific portfolio or strategy. So you're in it for the long haul, and you don't need to check your balances all the time or check your portfolio, because it will just be a bit more difficult for you to resist the temptation to actually react or try and anticipate different market movements when the portfolio manager is actively doing that on your behalf. And obviously that option is a cheaper option. But whichever journey you do decide to go on, if you want to do the work of a portfolio manager and go and buy underlying securities, or if you would like to hire a portfolio manager and just buy into a portfolio, you will need to ask yourself some questions. We have outlined 5 key points that you'll need to consider when answering this question of who do you want managing your journey. Let's look at the first point: philosophy and strategy. All funds or investments have a philosophy or strategy that outlines the way that they derive their value or generate the returns in the market. A portfolio manager, if you were to passively invest and buy into this, the portfolio manager is responsible for the philosophy and the strategy and deciding what securities get included inside of the portfolio or not. And they have a variety of different factors that they use to determine this. They look at the different cyclical trends of the economy, responses to different markets or industries and sectors to these trends. looking at the ratios of which they should include within the portfolio, as well as the different companies' qualitative and quantitative figures. And once they've got this philosophy or strategy bedded down, they can design proposed parameters. And now what that means is it would be something or a ruler that would measure whether a stock or security qualifies or disqualifies to be a part of the specific investment strategy. The reason for that is we do not want to just follow specific trends. We want to have something that governs our reasoning, because investing in the market can be an incredibly emotional experience. And so you need theory and quantitative understandings to help you set the parameters and the bounds of which you would trade that portfolio. Risk management exposures. When taking on different asset classes, you take on a specific level of risk according to that asset class. When you take on risk, you want to make sure that you're not taking on unnecessary risk for a small unit of return. And so risk management to specific exposures that you might have in your portfolio is incredibly important. If you were wanting to do the work of a portfolio manager, you would need to understand the different risks that are involved in your various asset classes, all the way that they're combined together, the way they respond to the economy through different cycles within the economy, and you'll need to have a level of risk management, understanding your asset classes as well as those securities across the different levels of risk that need to be assessed. Obviously, if you employ a portfolio manager to do it for you in passive investing within a portfolio or unit trust, this will be done by the team. Asset allocation or diversification. It's important when you are considering constructing a portfolio to have what we call diversification, even if it's inside a single asset class. So you may be trading only equities, but you need to have diversification within that asset class. If you are having a diversity of different asset classes, that also has its own way of measuring how to correctly diversify across a variety of different assets. Remember our quote that asset allocation is one of the largest contributors to our return stream. So this is quite important. Remember, when it came to asset allocation, the fund holding relationships or correlation is something that was extremely important. You don't want a specific event or piece of news to create an identical response across all of your holdings within the portfolio. You want a diversity. You want a balance of responses where a piece of news may enter your portfolio or an event in the market may enter the portfolio, and there's a variety of responses. Some go up, some are neutral, and some go down. So correlation, management of correlation is extremely important within a portfolio as well. And our final point, which is more of a softer point, but however still extremely important, especially with the human element coming into play quite strongly here, is discipline and dedication. There are many hours of quantitative and qualitative analytics that goes behind being a portfolio manager. And so when you are deciding whether you would like to be a portfolio manager for yourself and trade different securities actively, or if you would like to hire someone to do that for you, you need to consider this part quite strongly. Portfolio managers tend to rarely switch off. They're always having a look at the news, looking at market movements, things taking place within the market on their cell phones, laptops. They are always switched on, adjusting portfolios where they need to be adjusted. And so the stress element of this job is also one that someone needs to consider when you are wanting your downtime with family and friends over the weekend. That's not quite something that a portfolio manager could necessarily do in its entirety. There'll always be a level of being alert, listening, switched on, actively wondering, how could I apply this to the portfolio? And so that is very much a lifestyle that you would need to decide when answering this question. We are going to take a look at two main ways in which we could manage the journey for you. The first is through single funds. So this is largely in-class diversification. There are some like the Fairtree Balanced Prescient Fund, the Wild Fig and Woodland, that have a blend of different asset classes within them, being equity, property, fixed income, and cash blended inside of them, but largely you'll see single asset class with diversification taking place across securities within that specific class. And so we see we've got options over here which are unit trusts and options which are hedge fund, both stretching across your lower risk, medium risk, and your higher risk, and obviously respectively your short term. So here you see the different options coming through: your lower risk or shorter term investments, your medium to high risk, meaning media to longer term, as well as your higher risk being your longer term for both unit trusts as well as hedge funds. So now we come to the part of this session where we speak about the first in South Africa to blend these traditional long-only structures together with our alternative assets, and that is on our second leg, your tailored portfolios and your multi-managed funds. This covers both in-class diversification and cross-class diversification, really bringing something incredibly unique to our direct clients. And so taking a look at our unit trusts or our multi-manager funds, you'll see we have 3 medium to high risk options there, which is your longer, medium to longer term investments, as well as our growth hedge fund of funds. Now, what does this actually mean? This growth hedge fund of funds is taking a combination of the wild fig, Proton, and the Assegai and blending it together and giving it to you inside a single portfolio. So you are getting the benefits of more than one single strategy inside a single portfolio. And so we see here these tailored portfolios start to come through in both the pre-retirement and post-retirement situation, where you can have a portfolio of blended strategies together, really creating a great example of successful diversification. We also have some discretionary or bespoke notes coming to play here with the blending of hedge funds and long only. And so this could be quite a lot of information to understand how these two work together. So we've put this diagram together for you. So inside a multi-managed fund, you'll see that there are a number of funds. It has multi-fund. Here we have your global equity, some Fairtree Flexible Income Plus, Fairtree Global Real Estate, Fairtree Global Flexible Income Plus, Active Quants, which is equity, equally weighted top 20, which is also equity on the local markets, and you've got your global emerging markets, as well as the Fairtree Balanced Fund. So here we see a number of funds within this multi-managed fund. And so having a look at what this translates to is all of these single funds spanned across your lower risk shorter term, medium to high risk, medium to longer term, as well as your higher risk and longer term. And these are all of the portfolios or funds that you get access to within that multi-manager. So all of this is blended together as a strategy into that specific fund. So taking a look now at what is taking place inside the tailored portfolio, we see something rather interesting. Remember, this portfolio is called the Fairtree Invest Strategic Factor Prescient Fund. And so what's really important when having a look at the holdings inside our tailored portfolio, we see that that multi-manager fund is included within this portfolio alongside other funds as well. Here hedge funds start to come into play, and we've got 2 long only structures. So let's take a look at what's happening. So here we see the Invest Strategic Factor, which is over here, the same fund, and we have a variety of other funds added alongside it. So we've got our unit trust funds being our medium to higher risk, which is the Fairtree Balanced Fund coming in. Then we've got the multi-manager fund, which is the Fairtree Invest Strategic Factor Prescient Fund. And then we have 4 hedge funds coming into play over here, with the lower risk shorter term, medium to high risk being your medium to longer term, and your higher risk being your longer term. So all of this, your hedge fund structures as well as another 2 long only structures, actually is included inside a single portfolio. So what you are getting access to is incredible diversification taking place. Inside the single portfolio, you are getting these 8 fund blend of strategies blended together with an additional 5. And so you can really see the story play out quite strongly inside the return journey. Now remember, it's not always about returns and looking at returns, but it's an element that one needs to consider when looking at asset classes to see, is this portfolio well diversified across not only region, foreign and global, but also your diversity of actual assets being undertaken over here. So again, we see the story of the fund playing out and the journey of the overall fund translating into an understanding of returns. So now that we have a greater understanding of how to actually look at and understand what we are actually getting inside an investment, we trust that you will be able to match your financial goals to the correct fund fact sheets for your investment. Throughout these sessions, we have been navigating various elements of your financial forest. These elements have been very imperative for you to understand in order for you to make wise financial decisions. We trust that this third and final session was extremely valuable and will help you select the correct investment to help you meet your financial goals. Should you need any assistance or have any further questions, please feel free to contact us.